Hello everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking the time here for a few minutes to sit with us on our most recent update, and we're going to be pretty hyper-focused though in this one relative to the kinds of things that we're describing, and yes, they'll have relevance to the larger economies and the markets around us, but we want to focus on specifically our banking industry again, and you can probably guess the reason for that. Overnight, as of the time of this recording, so overnight, Sunday into Monday of this week, the Federal Depository Insurance Corporation, or FDIC as we know them best by the acronym, took over and then immediately sold First Republic Bank. Now, you may have seen First Republic in the news here over the last several weeks, especially Silicon Valley Bank and the issues that they had and were taken over by the FTC, and there were other names floated about other banks that may be in positions of duress. And certainly First Republic was one of those, certainly at close to the top of that list. There have been a couple of different attempts at resolving First Republic's issues here over the last couple of weeks as the FDIC has been involved with them. And there was even a buyout, or I would call it even a support attempt, by JP Chase and a collection of other banks to be able to provide some capital to First Republic. However, over the last several days, even though it really hasn't hit the news all that much, but over the last several days and then through this past weekend, there was pretty intense negotiation between FDIC and First Republic Bank about the fact that First Republic was going to be taken over by the FDIC. At the same time, because they had been involved with the process along the way, several other banks who had provided support initially from a capital standpoint to First Republic Bank in exchange for some ownership were also in negotiation with the FDIC to be able to talk about ways in which they might be able to buy all or part of the business. The short story is, going right to the bottom line very quickly, JP Chase bought First Republic Bank's assets and all of their deposits and also their business arms as a result of the takeover from the FDIC in an agreement with the FDIC to take it over. They also arranged for some lines of liquidity to be able to make sure that if they found some things after doing more extensive due diligence, that they would have some means to be able to address those as well. So I'm bringing that to you because we've had, as can be understood, emails, questions, calls with regards to, oh goodness, now First Republic Bank, what does that mean now since it's been Silicon Valley and Signature Bank and now First Republic? Is there contagion? Are there other banks at risk? And I want to just put your mind at ease with regards to this process, not because these aren't very serious issues, but because, and I know this may sound a little bit weird, this kind of thing actually goes on with some regularity. Now, I don't want to be too casual about it because certainly the size of these banks is really what has caught everyone's attention in the business end of the universe. $200 billion for Silicon Valley Bank, between 50 and 100 billion, depending on how you want to measure First Republic Bank. So some sizable banks in terms of assets, and that's really why they've hit the radar screen as far as what's been happening with them and then their ultimate takeover by the FDIC. But I want to just toss a couple of data points out there to you. Again, not to minimize what's happening here, but to highlight that from our end of the universe here, this isn't something that's terribly unique. For example, since 2001, can you guess the number of banks which have gone insolvent and have been taken over by the FDIC? You may think, well, maybe 20 or 50 or maybe even 100. It's actually a lot more than 100. It's more than 200. It's more than 300. Actually, over 500 banks have been taken over by the FDIC since 2001. And you're probably doing some quick math in your head and say, well, that's about 20 to 25 banks a year. Yes, except it hasn't been that linear. You recall we had the economic crisis there in 2008 and 2009. And actually, we had a couple hundred banks just in those 2 years that went insolvent and were taken over by the FDIC. So you have a hyper concentration in that time frame in 2008 and 2009. Generally speaking, when you look at it through the years, it could be anywhere from 0 to 5, maybe 8 banks in a given year which are taken over by the FDIC. For the last couple of years before this year, we hadn't had any. The year before that, I want to say 2017, excuse me, I believe is when we had 5 banks taken over by the FDIC. I'm bringing all of that to your attention because I want to put in some perspective about where things are for right now. No, we don't see contagion. No, we don't see issues with our banking system. As a matter of fact, from a liquidity and capital reserve standpoint, you can make a fairly legitimate argument that our banks have never been stronger. Now, are there banks that are suffering? Are there other banks which may get taken over by the FDIC? It's possible. There are a couple that are sitting out there even right now that could happen, that we would see them taken over by the FDIC as well. But very, very important to understand a couple of different things. First of all, nobody has lost a dime of their deposits. Not one person. I understand you see the kind of words that are put through our headlines: seized, takeover, forced sale, kinds of things. It causes us to get some knots in our stomach. That's very understandable when we're looking at these kinds of things. However, when we step back a little bit and look at the practical application of what's happening, we really don't have any reason to be concerned with our banks. And we certainly don't see the kinds of things like what we saw in 2008 and 2009, where we had a whole bunch of banks who were giving out mortgages to folks who frankly couldn't afford them. Nothing like that has been going on here. This, again, when we're looking at First Republic, is an example of a bank that got sideways on the rapid rise in interest rates with treasuries here over the last year and a half. Very simply, the treasuries that they have as capital went down in value significantly, as most treasuries did, and from a secondary market standpoint, as interest rates spiked up so much higher than where they were from a previous record standpoint. So when we look at that and we take a look at where things are, it's very understandable. What they didn't do, for whatever reason, and there are a couple of banks that are in this camp, they didn't mitigate their interest rate risk, which is pretty unusual for a bank of any size not to do that, but they didn't, and they got caught sideways from a capitalization and collateralization standpoint, and that's why the FDIC came in and took them over as deposits began to metaphorically and literally run from the bank. So putting that combination together proved to be too much for them to continue as an entity of their own. That's why the FDIC came in and backstopped them and led to the sale directly to JP Morgan Chase. So all of the branches, all of the wealth management clients, all of them are going to continue on in business in the same way, at least with JP Morgan Chase, or we'll have the opportunity to move those assets or move those wealth management portfolios to other entities. So I appreciate you letting me go on in an extended way about this. We watch these things very closely here. This is serious business, and we want to be very mindful of what's happening around us, both the positive and the not so positive. And then we want to be able to bring those items to you so that you may know in the best ways what we see, where our concerns are, and where we don't see concern. Now, that being said, I've talked about how we don't have concern about the banking system. We've got some real and serious issues in front of us. We have issues with regards to our national debt. We have issues with regards to the funding of our entitlement programs ongoing, Social Security, Medicare, Medicaid, that maybe aren't at the top of the radar screen for many folks today, but we've got to watch them. They're serious and they need to be addressed in pretty significant ways here over the next several years, let's say, or we're going to have ramifications that nobody wants. So I believe that they will be addressed, but it's going to be pretty significant in terms of how we address them and what that's going to mean to all of us who are working, and then folks who are not working and retired at this point, what that's going to mean in terms of impacts to them. So obviously we'll continue to keep you updated on that and to keep you aware of what we see. Just very quickly with regards to the overall markets, as we're seeing these bank issues that continue to dominate our headlines. The first quarter ended here a couple of weeks ago. We were about flat for most of the market indices, whether you're looking at bonds or whether you're looking at the more blue chip kind of stocks. The tech end of things, or the more aggressive end of things, generally speaking, as measured by our indices, not true for every stock, not true for every company, looked like it had a pretty big rebound as measured by the most commonly used NASDAQ composite index. Now, that doesn't mean, again, that every company is doing well. Remember, those tend to be the companies that last year didn't do very well and really had some significant negative years. So very common to see those kinds of things take off a little bit in terms of a bounce back. Hasn't gone all the way back to where it was, but certainly up off of the lows. So what does that mean for what we see here for the balance of the year? Well, we've still got to get through this time where the Federal Reserve is continuing to raise rates. As you've heard me mention now through several updates, so long as the Federal Reserve is continuing to raise rates, it's going to be very challenging for the market to price equities and to price bonds because it's constantly trying to hit a moving target when it comes to interest rates. And interest rates are a foundational element for pricing in the markets. So when we're looking at that mark continuously moving and we really don't know where it's going to settle at this point, that's why I expect that we're going to continue to see more of this washing machine kind of movement. We're going to pop up periodically, we're going to pop down periodically, but we're really not going to go anywhere new for at least a little while. I expect for that kind of pathway to continue at least until the Federal Reserve is done raising rates and probably several months thereafter. That kind of puts us at the end of the year. If you just do the math very quickly, as the Federal Reserve probably is going to raise rates through the balance of the second quarter, give some breathing room, 3 to 6 months, you're at the end of the year. So we're pretty cautious in terms of our expectations for what the market may do between here and the year end. And I say that both on the upside and the downside. So I'm very reserved in terms of what I'm looking at for the upside possibilities. But I also don't see at this point any significant catalyst that would suggest that we're going to drop significantly from where we are right now. But I'm going to continue to watch it. We're going to continue to watch it here with the team, bring you certainly anything that we see that would indicate that things are going to change significantly. And certainly as things like this come up with the banking system or with the Federal Reserve or anything along those lines. And in addition to that, certainly we'll bring them as soon as we have them here. Well, friends, I want to be respectful of your time. I appreciate so much your patience here and listening to me drone on a little bit about what are really some of the nuances of our financial system, but they have direct and real impacts on folks. And while it may not affect you directly or me directly, it does have an effect. And I want you to be aware of what's news and what's hyperbole and then what may be more substantive in terms of what's actually happening in the system. But as you know, always at any time, if you'd like to reach out to us here to chat about what's happening, to chat about what it means relative to your portfolio, do we need to make any tweaks or adjustments or think differently about things, always happy to do that. Very rarely, as you know, is there going to be a case where I'm saying, well, we really need to make some significant change immediately. This isn't one of those instances, but it can be a good idea just to kind of check in and to take a look at where things are. Perhaps we should do things a little bit differently or to tweak a little bit. But either way, we always enjoy hearing from you, and you're always welcome to reach out at any time. If you're a baseball fan, baseball season's starting to ramp up here. And if you're a Pittsburgh Pirates fan, I know it's only the first week of May, but pretty amazing start to the year. I don't think anybody anticipated it. Also signed their best player in Brian Reynolds to a long-term contract. For those of us who are Pittsburgh Pirates fans, it's a little bit of hope springs eternal. It's only the first week of May. Call me in September. It may or may not be the same kind of sentiment at that time, but we'll give thanks for it along the way. But whoever your favorite team may be, if you're into baseball, I hope you're enjoying this season as well. Well, friends, again, thank you so much for your time here. Always feel free to reach out to us at any time. And until that next time, I'll look forward to chatting with you soon.